Do you think we'll ever get to the point where the evergreen structures will become the core way of allocating to private markets, and then the closed-end funds will become the satellites? It's good to have you with us.
Michael, great to be here. Thanks for having us.
Yeah, good to see you both.
Likewise, Doug. You've built a fascinating business on the wealth side at KKR. Nick and I are excited to talk with you today about this evolution in the evergreen space. First, I think where we'd love to start is you have such a fascinating background in private markets, and then also just some of the stories that you've shared with us in the past about what gets you really excited about private markets and bringing it to the wealth channel. So we'd love to hear your background.
Sure. Great place to start. Thanks for the question, Michael. And I think you guys both know this, but for the benefit of everyone else on the podcast, I've worn a lot of different hats in this industry. I spent time as a banker, a financial advisor, a wholesaler, and more recently building distribution teams at KKR most recently, and a couple other GPs prior to that. But I've really been very much, from the early days in this business, focused, or maybe even fixated is a better terminology, on making private markets more available. So the first job I had out of school after spending time at a .com was as a financial advisor at what is now a big wirehouse. Wasn't known by that back in the day. And, I had an interesting book of business. My father was a New York City firefighter, and he was actually involved in the union, and every firefighter upon retirement had an overfunded pension. And that money would really come to me. I was on a team at the time. And we put into a mutual fund wrap or advisory account and do a smart asset allocation depending on the age of that individual. They usually retired between 45 and 60. But curiosity has always gotten the best of me. And I really, Michael, wanted to understand why these firefighters, who often near the end of their service would do a lot of overtime and, try to maximize their income during retirement, how they ended up with these overfunded pensions. And I discovered, and my dad was in the FDNY, that, that pension plan, which was one of the New York City pensions, was nearly 30% invested in retirement, or I should say in private markets in the late 90s and early 2000s, which, I think by today's standards, you see a lot of pensions, DB, and endowments that are at that level. But I think that was pretty unusual at the time. And it led to sort of better returns in our actuarial rates. And despite, again, this ability to do a lot of overtime and maximize their, their after retirement earnings, they still had these lump sum, excess amounts for us to deploy. And really, since then, I've had this, this bug that we really need to sort of level the playing field. At the time, for the rest of my book of business, the business owners, the anesthesiologists, the lawyers, they really didn't have any access, to the better outcomes that are associated with private markets. So, I think ever since then, my journey has sort of been, learn more about sort of the industry. And then I've always been someone who sort of likes to take apart, put things back together, architect. And ultimately, I think over the last 10 years, we've really built some really elegant, innovative solutions that, at this point in time, and it's not just KKR, but have really brought the entire private markets to a much wider audience. And that's, that has been, it's been a fun journey. I don't think there are a lot of folks listening when we sort of started talking about that, but, right now it's certainly sort of the epicenter of let's call it wealth and asset management.
From that point, as you think about your experiences working with the wealth channel and in various shapes and forms, how has that informed how you've decided to build product today for the wealth channel?
It's a great question. I think alts, and I'm sure we'll touch on this throughout the podcast, alts was very different, or private markets was very different than traditional asset management. Again, you were, generally sort of in the private markets, you were only putting capital to work once you identified an investment. You didn't sort of have it working for you the entire time. So you have capital calls, you have money being returned to you, you have wires to fund those capital calls, wires to come back on realizations. You had more complicated tax documentation. And I think all of those, while they helped pensions such as the FDNY get better outcomes, they really created a choke point and a lot of, pain points for the average high net worth or even mass affluent investor. So, quite honestly, we were trying to solve for the impossible, which was how do we sort of get rid of those choke points? How do we reduce the hassle factor, make private markets / alternatives easier to consume, while at the same time not really, diluting or reducing the exposure or potential to deliver, that those benefits of private markets, whether it be in the form of lower volatility, great that correlation to an existing portfolio or positive correlation to an existing portfolio, as well as in many cases higher yields, higher returns.
I think that
it was kind of a dilemma.
It's a great intersection point to Nick. You obviously have partnered with KKR and Doug in a number of ways, but as you thought about working together and solving some of those problems that Doug just mentioned, how did you go about thinking about that?
Yeah, Michael, well, the decision to partner with KKR, it's an easy one. First of all, I've known KKR for 20 plus years, long with some of my partners, long-standing relationship. But they've identified very early on the importance of the wealth channel, and they're not afraid to experiment, to try new things. I know Doug's going to talk about, the conglomerate model in a moment, but, they're really out there on the front lines and, reaching this in the independent market, what's ultimately a very fragmented community, takes a tremendous commitment in resources, in time. So KKR has been investing in the channel for a long time, and we've seen just with some of the largest GPs, just incredible innovation. A lot of the structures, Michael, that we talk about, and Doug knows intimately, but registered funds, 40 Act tender offer funds, interval funds, non-traded REITs, non-traded BDCs, etc. They've been around for 20 plus years. But it's what the GPs are doing now with these structures, where we've seen fee compression, we've seen, the ability to deliver something closer to true institutional style pricing. So that's a mentality where you're playing the long game. So when they build these products, they're building them to deliver a strong result to the underlying investor, because it's the only way they're going to be able to grow their presence and their footprint in the channel. And KKR is committed to that. Also, it doesn't hurt that they're one of the pioneers of private equity. They've been around for 48 years, and they've got offices all around the world. So very easy decision to partner with KKR.
A pioneer of private equity, a pioneer of the conglomerate model. You mentioned that, Nick. Doug, would love for you to touch on what your approach to the wealth channel has been, and how does something like the conglomerate model fit in?
Yeah, thank you for that. And we've been indirectly sort of investing on behalf of individual investors and families from our origins. Our biggest sort of AUM still resides in defined benefit plans. Obviously, that's benefiting folks as they near and in their retirement and in the distribution phase of their wealth. But I think most of us are aware that DB plans, there's not new plans being created. Most of them are they may still be growing by market action, but there's not adding new participants, and largely they're distributing out. So we, as Nick said, we've had this commitment. We've been in wealth for a long time. We started to do about 10, 15 years ago, closer to 15, we started to make our drawdown episodic private market funds available in really the ultra high net worth parts of the market. Now, granted, they have higher investor eligibility, so we developed partnerships with mostly the large private banks and wirehouses, and they could access our Roman numeral private equity, private infrastructure, growth equity vehicles. And that really was what we did in wealth till about 5 years ago. Coincided with, me joining the organization. I think KKR, sort of doubling down on the wealth chapter. And, we certainly have shown that commitment. We've grown our team to about 100 people globally. We also, at one point in terms of standing up all these innovative structures, committed more than $2 billion from our balance sheet. And most importantly, we really, even though we manage money on behalf of individuals through institutions, we really wanted to make sure that we were delivering the same investment experience. So that really required us, to look at our fund documents, to do, to break glass, quite honestly, Michael and Nick, to actually deliver the same investment content. So as part of, before I was saying we had to sort of reduce the hassle factor, increase eligibility, the last sort of piece of that, which really drove innovation, was us wanting to bring, the same investment content, the same deals, not cherry picking, not doing, either deals that didn't necessarily meet the requirements of the flagship fund. I think there is a push and pledge from the industry to do more of that now that, there are solutions for each asset class that effectuate that. So that has really been, I think kind of our true north here, what defines us. And, I think it's been, I think it really, again, shows our commitment to wealth. And, I think it's going to deliver, hopefully, the same outcomes that our institutional investors, maybe on behalf of wealth, have generated for 4+ decades.
On that point, if we think about Maslow's hierarchy of needs for the wealth channel, is the conglomerate model the self-actualization of product innovation in the wealth channel to enable the investor to get access to, like you said, exactly the same product that you're offering to other types of investors?
It's a nuanced question, but it's at least a partial yes, Michael. And I think, depending on the asset class, legislation has enabled access to that, to certain asset classes, even in private markets, made it easier than others. So in credit, and Nick went through these structures before, you have sort of BDCs, which allow you to sort of, private credit. Doesn't just have to be corporate direct lending, although that's generally what we've seen in sort of the BDC structure. You've had REITs, public REITs, non-traded REITs, private placement REITs. That's really enabled access to mostly income-generating real estate, although you can really do any real estate in a REIT. You even see mortgage and credit REITs. But I think when you sort of went to the remaining parts of private markets, which at least at KKR is private equity and private infrastructure, and wanting to deliver the same transactions and deals, there wasn't a structure that could do it. We invest largely for control, so those aren't securities. So things like the 40 Act become very, very challenging unless we're going to do different deal flow or do minority interest in somebody else's deal. That's why, at least in the 40 Act space, you've seen great solutions in private markets equity or private equity, but they've been much more of a secondary nature because those become security interests. So we really had to, again, the firm leadership here, the founders all held us to, we want to deliver the same content. We want to deliver accredited investors. We want to make it easier to do. And I know, Doug and team, that sounds like it's never been done before, but find a way to do it was really the message. And, we spent time in the laboratory. We stayed very, very active during COVID and really built. We were the last GP to do anything semi-liquid, to my understanding, at least of like the big 5 or 10 GPs. So we played a lot of catch-up. And you did need a new, at least domestically, you did need a structure, which, by the way, isn't new, but its application's a little bit different here to deliver that, those last two pieces, which are really half the equation, by the way. Infrastructure and private equity are huge parts of private markets, and we'll probably dimension some of that TAM and the size of some of those pools later. But, it really starts to bring the entire category to life. And that was what we set out to do. And, I thought at first, like, a case of having to bend reality, but, you sort of looked at what others have done, and there's examples of conglomerates that are publicly traded. Berkshire Hathaway is a great example. We thought about doing this for a split second as a listed structure, but then you're back to having all the beta of the public markets, which is not what you want if it's a pure play private market solution. So, we were informed by, sort of what others had done before with some adaptations along the way. And I think we've seen some recognition, some acknowledgement by the industry, because now we've seen some fast followers really doing the exact same thing for their capital, bringing private equity, private infrastructure. We've seen these conglomerate type operating companies from contemporaries, which is great to see, because I think it's a real enabler to access and getting this exposure in portfolios.
So walk us through and unpack the differences between conglomerate model and an evergreen structure. And I know there are different types of evergreen structures, and Nick would love your thoughts as well, because I'm sure you had to think about this as you figured out who to partner with and how and why.
Yeah, I'll start here. Nick, do you want to start?
No, go ahead, Doug. You start. And
I was going to say, we conglomerates, and again, it's really an operating company. It's an unlisted operating company. The best example is this unlisted Berkshire Hathaway. That's the analogy here. They own and operate businesses, and That's what we have a history of doing, Michael. But just because it's an operating company or a conglomerate doesn't mean it really, when an investor commits to it, doesn't feel really any different than a REIT, than a BDC, than other structures where they've been getting access to alternatives in private markets. There can be multiple share classes. These are all fully drawn structures. They report sort of NAV and performance off that NAV. Reporting looks very, very similar because it's a continuously offered product. We take capital in, we need to really deploy that in new transactions. When money comes back to us, do the same thing. And you're always sort of, you're always deploying that capital. You're on that treadmill. And that's really no different than what continuously offered REITs, continuously offered BDCs do. It's just not in, a 40 Act or like what they call a direct participation program, which is really most of the REITs and BDC type structures.
Nick, how do you think about some of the nuances between something like a conglomerate model and other types of evergreen structures?
Yeah, well, Doug put his finger on it when he said that in the case of private equity, and I didn't even know this 11 years ago when we started iCapital, but the SEC prohibits private equity firms from starting managing top to bottom their own private equity funds and registered funds. And they do that because they want to ultimately prevent self-dealing. So players had to look at it differently, and it's why when Doug commented on the fact that as the market's evolved, we've seen some really great 40 Act tender offer funds focused on private equity, but they generally today are comprised of secondaries and syndicated co-investments, and they're managed more by the fund-to-fund players. So if you're a private equity firm and you want to reach mass affluent and you want to reach the 14 million accredited households, you have to do something different. Evercore that released a report, and they were analyzing, I think it was Blue Owl, but they calculated that $1 in an evergreen fund generates, on average, 3 times more fee-related earnings, given the more permanent nature of the capital and the fact that it's compounding on the NAV. So I don't want to go too far here, but it feels like we might be at an important inflection point where this is becoming a win-win for both individual investors and private capital firms like KKR. And when that happens, where consumers and businesses both benefit, there's often a transformational change in consumption. So if you look back, only the very wealthy could afford to fly during the jet age in the 1960s and the 70s, but then technology improved, the cost of commercial flights came way down, and we really saw the democratization of air travel. So I don't know, Michael and Doug, are we on the cusp of experiencing something, along that, like that, of that magnitude in the wealth industry, or the convergence of wealth and the private capital industry?
I think it could be right, Nick. I do think also just now having access to all the building blocks in a form where, again, it's evergreen, it's fully deployed, it has all those sort of conveniences, and it reaches accredited investors. Like all of that is going to, definitely the whole pie is going to grow. And I think that is important. I do think, though, we did intentionally, just like it was important to our C-suite here and senior leadership, to give the same investment content. And then we look back historically at that investment content and investing pari passu. We've invested a majority of everything we've done for control, which has allowed us to do an operating company conglomerate structure. But from a pricing perspective, we've tried to factor in that evergreen strategies have more capital working for you all the time. Has a really infinite hold period, but assuming a like hold period, we tried to make sort of, the fees be, largely at parity. We didn't want sort of either pool of capital who have, been long-term, investors or new investors to KKR to really have a different experience. And we don't want that to be on the performance, the exposure, or the fee side. That was absolutely a guiding principle for us. But, it does have, to your point, more efficiency so that those fees are never sort of on undrawn capital. And I think that does have a psychological or philosophical kind of impact on potential and existing users of evergreen strategies.
It does bring up a really interesting point of, are you, Doug, seeing investors behave differently when it comes to how they think about allocating to and then managing their exposures in evergreen structures? Like, do they think about this as truly permanent and just let it compound? Because in some ways, if you look at that research, you should just let that compound if that's the case. And yes, there may be times to need liquidity and you provide for that, but like, are investors behaving differently as they think about evergreen structures than they would in a traditional closed-end world?
We're starting to see that. I wouldn't say it's been sort of fully appreciated by the market yet, but let me kind of break that down into like two examples. One is we had, and I won't necessarily identify the channel or the intermediaries, but we had a lot of intermediaries who were slower adopters of evergreen solutions, thinking that they catered to the high end of the market and they continue to want drawdown. But then they started to sort of lose business to their contemporaries who were doing sort of evergreen strategies in every asset class. And now that kind of has led to, I think, a more quick and rapid adoption. And then we have a couple of advisors that we've got to know really, really well in RIAs where their book of business may be sort of predicated or really sort of centered around long-term, multi-generational wealth. In one case, it's sort of young athletes that get, signed big, big salaries, and they're really taking a large piece of that, putting into something like private equity that has a premium even over the public equity market, and kind of letting that compound over, till they're 65 years old. And if you can, as Nick gave the numbers before, even at a mid-range of, what we hope our expected returns will be, you're talking about, kind of hitting a 3x multiple times. I mean, over 40 years, that's 3, that's 9, that's 27. It can really, really add up over, a couple of generations. So I think there's that light bulb going off. I don't think it's necessarily ubiquitous yet, but I think it's starting to come. And certainly, we've seen investors of all levels of wealth really utilize, look at, and ultimately commit to evergreen strategies. And I think the entire industry this year is now flipped over, where more business is being done in evergreen than episodic. That's never happened before. It's happened really, really rapidly. And I think because, again, all those building blocks are available and easier to consume.
Certainly that's the case on the wealth side, where more dollars are being raised in evergreen interval fund strategies, certainly as of late. Do you think we'll ever get to the point where the evergreen structures will become the core way of allocating to private markets, and then the closed-end funds will become the satellites?
It's probably too early to make that determination. As I said before, we need both of these structures to coexist. We're investing alongside our private drawdown Roman numeral vehicles. We're also in together, out together. We're not holding those assets after, you have to dispose of them in the drawdown funds that's participating alongside. And we think that's actually really powerful, because if you look at, what we do in terms of buying good companies and making them great and doing value creation, assessing their human capital, their procurement, their benefits, their business strategy, their business lines, like all of that, there is a period of time where you're making sort of higher returns. When we actually ultimately stabilize a business, we sell it to a strategic buyer, we IPO it, that is generally, returns have gotten a little more normalized. So like for us, I think both episodic and evergreen will continue to exist. I don't foresee a sovereign wealth fund or a huge pension plan doing evergreen vehicles, because they can be a very sophisticated deployment strategy. They can probably match our multiples. But, for sort of the middle market institutional investor, it's interesting. And I do think for the ultra high net worth who can access both, I do think evergreen becomes a little bit more, I don't mean core in terms of return, but like that ballast with sort of that satellite exposure being episodic.
I think that's a great segue for both of you who touch on what's been most effective in educating the industry on evergreens. Nick, starting with you on what's been most effective in educating the industry on the why and the how of evergreens.
Yeah, and Michael, I think it's really sort of you have to adopt an omni-channel approach. So everything applies. You can reach more people, obviously, doing a webinar. You can go out to conferences and, talk on the stage. You can do one-on-ones. So we sort of look at it and we think that, and we at iCapital, we have sort of all the above. So we have people all over the country who are presenting, and very much it's the learning curve for a lot of these advisors can seem a little steep, but you just try and break it down, avoid industry acronyms, speak in plain English when you're talking about the utility of private capital. When you're talking to people and you're telling them kind of what they're missing out on or their clients are if they're not incorporating some private equity into their equity book. but we have an online program. It's a joint venture with Kaya that has 10 modules. Each one earns a CE credit for the advisor who takes it. It's in a not-for-profit, by the way. We have product training, so we have very specific product level information. So an advisor thinking about offering a fund or putting a fund in front of their client, they actually go through that, and it allows them to sort of demonstrate that they understand the strategy, they've done their homework on the fund, they understand the liquidity constraints, the fee structure, etc. So I think you have to do everything, and it's a never-ending process, right? Education is really critical, and I think just talking high level about this shift between public and private markets, and now in many respects they're changing roles. We're seeing private capital fuel more and more of the growth across the economy, and you've heard us say this many times. If you look at the 22,000 companies in the United States that are generating $100 million of annual revenue or greater, 87% of those are private. And you hear the old say, private companies are staying private longer. Well, a lot of private companies have no intention of ever going public. So it's not that they're staying private longer. There's trillions of dollars of dry powder. They don't have to. They can stay focused on their 3 to 5 year, 6, 7 year value creation plans without the distraction of, quarterly earnings, without having to abide by all the regulatory burdens of being a public company, without having to release their financial information, their KPIs to competitors. So it's almost not even a level playing field anymore. But I know Doug KKR has spent a tremendous amount of time on education as well.
Yeah, I think you hit a lot of it. I mean, this is, private markets are still sold, not bought. Education plays a huge role here. So, I mean, we've developed at KKR, we have our Alts Unlocked, which is sort of a series of, learning more about alternatives broadly, then getting into individual asset classes, covering topics like value creation. We invite, I don't think this is unique to KKR, but we have our KKR Academies where we invite RIAs and financial advisors in to really hear more from our thought investment leaders, get more comfortable. It's never sort of talking about individual solutions, but more about, the entire spectrum of alternatives in private markets. And, that has been a powerful tool. I do think, not more recently we started for at least advisors and RIAs with the right sort of profile of clients. We've actually had them spend more time with our value creation capital markets business because they may in the future have sort of succession plans. They want to just understand how they can tap those markets, and they may not have been large enough to really kind of spend time there, but we might as well use all of the different, our wheel, as we call it, of sort of value creation to help these advisors with their, family businesses or family-owned businesses. So all of that we're definitely committed to. And I do think, what has really worked is to simplify this, to your point. I mean, you'll probably get into this in a minute, Michael, but, when it's kind of alternatives and I have to carve out a separate piece of my book of business to do this, and then you start talking about private credit being larger than, corporate high yield, and you talk about 90% or nearly 90%, as Nick said, of companies with $100 million of revenue being private and having all this capital to access, they don't want to even ever go public. It really flips it on its head. And it's private markets, but it's still equity, fixed income, and real assets, just a different piece of that. I think that really, is again that light bulb moment for the end investor in terms of wow. And then, you can also get into returns over time. I mean, you have DB plans that, again, were very much started from, they've outperformed VC plans because they have access to all of these different solutions that until recently true individual investors did not. So.
Yeah, Doug, from that perspective, I want to pick out something you said, which is no longer really calling it alternatives. I think that's a great segue to where is this industry heading? And I want to start with you on this because you said something that really struck me and you see it on the website at KKR. You call yourself private markets firm. Why are you no longer calling this alternatives, but rather calling it private markets?
Yeah, it's a great question. And I think, it's driven by a couple of things. One, again, alts has become, a little bit more mainstream from all the good work that iCapital, KKR, our contemporaries are doing, all the platforms and all different channels that we work with really, sort of, I think, making a more compelling case and having more tools to do alternatives. But, at the end of the day, like we're still investing in operating businesses, but in the same sort of asset classes I talked about. It's all equities, it's fixed income, it's real assets, which is both real estate and infrastructure. And, and that's how people sort of think about how they already, segment their book of business. And this is just giving them access, they're only sort of investing at, I've seen the iceberg analogy, but this is sort of all the rest of those privately held businesses. This is giving them access to those equity, fixed income, and real assets, just a different segment of those markets and asset classes. So we have, I think in recognition of the fact that alts has become more mainstream, I think very recently we announced an exciting partnership with Capital Group, which is going to deliver hybrid solutions in the marketplace with, hopefully no eligibility and maybe get us that last mile of, I can't do the math in my head here, Nick, but if you take 13 million, the total number of households that don't really have any access to alternatives today, that really made us self-reflect and say, it's not about sort of alternatives or maybe people are doing 3, 5, 10%, but it can be something much bigger and bringing much better outcomes to, every investor of all shapes and sizes, to their allocation. So that has really helped push us. And I think the entire industry is probably not far behind, but, stopping this reference to sort of alternatives where it feels exotic. You can't be too heavily exposed there. You always still have to be prudent and make sure you're matching, sort of the liquidity profile to your tolerances. But, that 4% weighting, which a decade ago was 2% weighting, and 30 years ago, New York Common was 30%. Hopefully this helps close that gap and deliver those types of outcomes.
One follow-up there, and then I want to pass over to Nick. But Doug, on the point about calling it private markets instead of alternatives, how much has that changed how allocators actually look at private markets and then invest in it?
Not enough yet is the honest answer. I think it's leading to everyone sort of, doing that, self-assessment and reflecting and contemplation. It's just one of those questions that, makes our advisors and clients ponder a bit. I think it's going to lead to more, longer term sort of changes in behaviors and allocations, Michael, but it's starting that, conversation and debate. It's really the tool it's been thus far.
Well, I think there you also mentioned something, the partnership you're doing with Capital Group to create these hybrid solutions. It's something that, Nick, we've discussed in the past, and I know you have a lot of thoughts on this around, the market structure evolutions of prior asset classes as well as products. So we'd love to hear your views on that. And I know you have some thoughts and questions there as well.
Yeah, Michael, we've spent a lot of time talking about this, and I think that KKR's partnership with Capital Group is a great example where, you're developing, public-private hybrid products where, in this case, I think it's the credit. KKR is sort of like the Intel inside providing the credit. And we're seeing across the industry a lot of really interesting partnerships. BlackRock just teamed up with Partners Group to offer model portfolios. So, retail investors will be able to choose from different risk profiles, conservative, moderate, aggressive, to determine the allocations. And, at iCapital, we launched model portfolios earlier this year. And what we're doing from a tech standpoint allows investors to access a diversified portfolio through a single subscription document. So they don't have to sign up with each underlying fund individually, which is a very cumbersome process. And then you have sort of a single managed account with unified portfolio construction and management, includes model rebalancing. So I think all of these things ultimately are helping to bring private equity and private capital, because a lot of what that is credit, what I just spoke about, but help bring it from what's historically been sort of a tactical allocation, again, people just thinking of it as alts, to really a core allocation. And I think there was a Cerulli report recently. I think it said that 13% of alternative assets came from retail clients last year in 2023, but that share is expected to rise to 23% by 2026. And that percentage, I believe, includes liquid alts. So if you're really thinking about, longer lockup, credit, equity, infrastructure, et cetera, I think it's a lot lower than 13% today. So we have a long way to go. I think that Cerulli report was projecting that by 2028, financial advisors are expected to be managing something like $3.5 trillion in alternatives for their clients. And I think by that point in time, it won't be called alts anymore. It will be the private capital markets. And I think people will be like, boy, whether it's equity or credit or infrastructure, no matter the asset type, you're going to have some exposure to the private markets. And by the way, that instills a buy and hold discipline on the underlying investor. There's not assets that, even though some of them are already, there's already, ticker on some of these, the interval credit funds are rendering a daily NAV, but these are not products that you want to trade in and out of. And that's why there's a lot less volatility. Most of these on the equity side, they're achieving these returns with half the volatility of the public markets. So they're slower to mark up, they're slower to mark down. It's a smoother ride, but these aren't investments that you should be looking at every quarter. These are investments that you should be watching over extended period of times or time periods. And again, I think we're headed toward a market. It's already happening with a lot of people's portfolios where it's regarded as a core allocation today.
I think that's such an interesting point, a great segue to the kind of industry evolution here. So I think both of you probably have a view on where things are headed, but as what's happened with other products, mutual funds, ETFs, the largest players have seemed to develop dominant positions. I know, Nick, you've thought about this a bunch. I'm sure you have, Doug, as well. Like, where does this all go? Like, who ends up becoming the dominant players in the space?
Yeah, I think, the largest sort of GPs have sort of made big inroads because they've had dedicated teams. They've been the product innovators. But again, as we sort of see this private markets, industry grow to levels that Nick just walked through, and I think other sponsors and asset managers recognize that, what it sort of takes to win in private markets and build dedicated teams and more educational content. And there's differentiation. There's folks that cater to, sort of large private markets, mid-cap private markets. We'll see some of those same traits develop. It won't all be dominated by a handful of firms, but that's probably who's going to sort of, as we've seen, lead and pave the way here, Michael. And I do think, we're also just scratching the surface in terms of the pools of capital that we're reaching. Most of private markets is still done in sort of transactional accounts. It's not really in retirement accounts yet. It's not really in a little bit of advisory, especially including RIAs, but no fiduciary, kind of discretionary pool. So there's still a lot more to be done here to probably make this be, the weighting that I think all of us see this playing in a client's portfolio. I think again, we'll see, while all the asset managers figure out they can't necessarily use the same team to sell alternatives with all the extra education that's required and sort of build differentiated, product or content. And I think that, their participation in smaller GPs who are commit, and they really need to all commit, headcount, seed capital, innovation. You do all that, there certainly is, the pie is going large enough that a lot more folks can have a slice.
I want to hear from each of you what your most closely held view, your evergreen thought that could be that you've always had or could be that you've developed over time has been or is on private markets.
I think we said it throughout this podcast is sort of how quickly the evergreen has really taken over, at least with wealth. And does it sort of go further into some of the institutional, middle market type accounts and clients out there? Remains to be seen, but it has really developed very, very quickly for an industry that normally takes decades to sort of see changes, like from mutual funds to ETFs. This is happening at a much more rapid pace. And the good news is, I think we've seen firms really put their best foot forward and focus on sort of the pedigree of their investment teams, of these solutions, of education that, I think is leading to a more rapid adoption. And this is going to be a disruptor. This is absolutely going to be a disruptor and, at a pace that rarely this industry sees. I'm kind of excited to see where it goes. I don't exactly know what the sort of end state is, but we are really just scratching the surface here. We are. Especially if, the other asset classes just do what credit's been doing, like private credit's been doing, this industry would be huge.
Nick, what about you?
Michael, the just to pick up on actually, what Doug was talking about a moment ago, before he asked the final question, just, it's just going to be not a winner take all, but like ETFs or, the top player is going to dominate the channel. I think that, first of all, it remains to be seen, obviously, and early on, they're the ones who are raising the vast majority of, the capital that's flowing into Evergreen products. But it always takes, the big players are, as Doug said, opening the door. And they're going out and they're doing the hard work of educating the market. And I think there's 5,000 GPs around the world, across equity and credit, et cetera. And if you think about the top players who have, north of 100 people in their wealth management groups that have made the big commitment and the big investment, and then you think about just maybe the next 50 or top 100 GPs out of the 5,000. Well, those are firms that have been around in most cases, for decades. And they have tens of billions, if not, north of 100 billion of AUM. And I don't think those firms are all going to sit on the sidelines with, a marketplace that's, the accredited marketplace in the U.S., accredited on up, is a, $40+ trillion market. So they want to build their brands. I think some of them actually are getting a little concerned that if they don't do something in the next 2 years or 3 years, maybe they get shut out. So they're at that point where they want to make a decision, but they don't necessarily want to go hire 30, 50, 100 people. So there are other ways to do this. And for example, this is a little bit of a shameless plug, but, we're partnering with these firms. So, they don't necessarily have to have those boots on the ground. They don't necessarily have to have that Evergreen, product structuring expertise. But in this sort of new partner model, which we believe is going to replace the old intermediary model, which I think is almost dead at this point. But that partner model is one where the GPs take an ownership stake in the vehicle. And it's truly a partnership where they very much want to go out and meet, the top 200, 300, 400 independent wealth firms that are, all over this country. And they want to meet the key decision makers, the CIOs, the head of research or alts at the home office. And so that's a way they can do that and build their brands in partnership with someone where, again, you're trying to bring to the market, institutional style pricing. So the way they do that, part of that partnership, and we did this with KKR with the 40 Act Fund, we also have Vista and Warburg, but that all started with KKR treating the fund and the underlying investors like an important institutional LP. So that means access to deals, all their private equity deals, and it means also better pricing. So I think that's what we're seeing across the market. And by the way, we're seeing the product innovation go like this, and the industry's infrastructure to support it, it's getting there. It's kind of going like this. So there's this growing gap there. And that creates a tremendous opportunity from a technology standpoint. And that's really iCapital sits at that intersection. And we're furiously building out, all the workflows and trying to keep up with this innovation so that pre-trade, post-trade, we can make it very easy for advisors and their clients to utilize these products. So I think we're entering an incredible, new phase of private capital.
This was fantastic. Hear all about the product innovation that's happening, how this space is opening up with new vehicles like Evergreens, what you're doing in this space. Doug, Nick, thanks so much. This was a great conversation.
Thank you for having us.
Thanks, Doug.
Thanks, Michael. Thanks, Nick.
Thanks, guys.
The material herein has been provided to you for informational purposes only by iCapital Inc. iCapital. This material is the property of iCapital and may not be shared without the written permission of iCapital. No part of this material may be reproduced in any form or referred to in any other publication without express written permission of iCapital. This material is provided for informational purposes only and is not intended as, and may not be relied on in any manner as, legal, tax, or investment advice or recommendation, or as an offer to sell, a solicitation of an offer to purchase, or a recommendation of any interest in any fund or security. You should consult your personal accounting, tax, and legal advisors to understand the implications of any investment specific to your personal financial situation. This material does not intend to address the financial objectives, situation, or specific needs of any individual investor. Alternative investments are complex, speculative investment vehicles and are not suitable for all investors. The information contained herein is an opinion only, as of the date indicated, and should not be relied upon as the only important information available. Any prediction, projection, or forecast on the economy, stock market, bond market, or the economic trends of the markets is not necessarily indicative of the future or likely performance. The information contained herein is subject to change, incomplete, and may include information and/or data obtained from third-party sources that iCapital believes but does not guarantee to be accurate. iCapital considers this third-party data reliable, but does not represent that it is accurate, complete, and/or up-to-date, and it should not be relied on as such. iCapital makes no representation as to the accuracy or completeness of this material and accepts no liability for losses arising from the use of the material presented. No representation or warranty is made by iCapital as to the reasonableness or completeness of such forward-looking statements or to any other financial information contained herein. Securities products and services are offered by iCapital Markets, an SEC-registered broker-dealer, Ember FINRA and SIPC, and an affiliate of iCapital Inc. and Institutional Capital Network Inc. These registrations and memberships in no way imply that the SEC, FINRA, or SIPC have endorsed any of the entities, products, or services discussed herein. Annuities and insurance services are provided by iCapital Annuities and Insurance Services LLC, an affiliate of iCapital Inc. iCapital and iCapital Network are registered trademarks of Institutional Capital Network Inc. Additional information is available upon request. Copyright 2024 Institutional Capital Network Inc. All rights reserved.